Good morning, everybody, and welcome to another episode of Do More With Your Money podcast/video log. This is episode number 47, and it is the Investors in Global Markets questions and answers. So this morning I am joined by a lovely panel, most of which you already know. We have Mr. George Bell, we have Mr. Greg Lang, Miss Rebecca Wright, and Mr. Jamie Sexton. So good morning, everybody. First question, how are you all?
Very well, thanks, Diane. How are you doing?
I'm all right, thank you, George. It's very glum though today, isn't it? Dark and dreary and dark.
I'm still not sure if the sun's came up here yet in the Tyne Valley.
No, not here in Newcastle either. No sunshine. Greg, how are you doing?
Yeah, good. I find it strange driving to work in the dark and then driving home in the dark, so I don't get to see any daylight really. But it's not bad. And I know I've been on the podcast before and talked about it. My sort of advantage of coming to the office means good Wi-Fi and obviously a nice beautiful background, as well, as opposed to Jamie with his bike and his tree there.
What kind of tree is that, Greg?
It's a lovely tree, Jamie.
It's nice, isn't it?
It's a nice, pretty tree.
The green one. But Greg, do you not just find it weird driving to the office completely now, regardless what time of day it is? Just like, I'm driving to the office. This is not normal now anymore.
It's absolutely fine, because my normal commute pre-COVID was about 50, 60 minutes. And I can get into work now in 22 minutes. And that's not by driving faster. It's just the sheer lack of traffic. As George knows, I'm a very sensible driver. I don't go over the speed limit, and but yeah, it is strange, Diane, because it's not normal driving on the A1 and not being just stuck in back-to-back traffic for 45 minutes. So it is strange, but I think it's obviously an awful term, the new norm, isn't it? And I can't wait. Sadly, get back on the motorway with loads of traffic, because it means I'm getting to see all of you people in work instead of in little boxes on my screen.
Yeah, not entirely sure.
I popped into the office.
Yeah, but how we look.
The office earlier in the week, and I thought the same, Greg. You fly in without any traffic. It's fantastic. I was actually quite excited to get into the office. It was like a little day out.
Mm. You fly into the office, George, because you get your chartered jet. That's why.
That'll be right.
That's after he's done his star jumps in the garage, though. Don't forget, we've got Star Jump George. So, Rebecca, how are you? How have you been?
I'm good. I'm grey and miserable, like everybody else is here as well, but it's the weekend, so happy. What can we complain about?
No, very, very true. Here's hoping this podcast cheers everybody up then with all of the dark, glum, grey, driveless mornings.
Diane, I'm actually very happy, because for the first time in about 3 months, my little boy went to sleep at 7 o'clock last night and didn't wake up till 7:30 this morning. So I've had a full night's sleep, no interruption. So I'm probably the happy one on this podcast this morning. No bags under these eyes.
Oh, there's plenty under these ones, though, because I didn't have a great night's sleep, Jamie. And I think I said this to you the other day when you mentioned that he'd also slept through the night there. And I was like, he's stealing my sleep, because I'm not sleeping properly at all at the minute. So I want it back. You are not keeping my sleep. No chance. Right then, so I think with the introductions and things in the way, I think if we just get on with how the week's been, so what's been happening for us individually, but also collectively in the office. And what I do want to mention is, if the viewers like this, well, in fact, if you don't, please subscribe in the subscribe box. We would love that. We would want to see the subscriptions go through the roof. And you'll be notified, if you press the notification bell, you'll be notified of all of these podcast arrivals in your inbox. So yeah, let's get into it. I think the first thing for me to mention really is the charity that we've been supporting, which is Cash for Kids. Now, I don't know if it was last week's episode or the week before, I can't remember now. Esther mentioned, and she discussed obviously what we were doing, and it's the second month that we've supported Cash for Kids. Last year we did the gifts under the tree. This is really hard to do, the gifts under the tree at festive time for the children, but obviously with COVID and things, when we're asking for donations. So we would love it if anybody watching would like to donate, please. Cash for Kids it's a local charity that supports children from ages 0 to 18 that are disabled, disadvantaged, they're sick, of households and things. So yeah, we really, really want to get behind these. And the target is £5,000. And I don't know if any of you have seen it this morning. I looked yesterday and it was at 4,380 something, I think. So I don't know if it's gone up overnight, but yeah, we'd love to smash the 5k target. So 2 things from me: please subscribe and please donate. So with that said, have you all donated? Because you see a lot of names and some of them are anonymous, so you don't quite know who has been the big donators.
I have donated, but I managed not to say the C word as of yet, unlike Jamie, who I think has said it at least 5 times to me.
Well, as I don't know if everyone knows, we did Rebecca made me eat some ridiculous food on a I'm a Celebrity challenge on a work webinar, and everything that we ate, there was, I think it was £25 for every food that you ate, and then it was £50 for probably the most disgusting thing I've ever even seen in my life, which was I can't remember even what kind of egg it was. What was it, Rebecca?
It was a fermented egg, Jamie.
Yeah, a fermented egg. So rather than eat the fermented egg and get 50 quid from the company, I'd just put the £50 in out of my own pocket. But just to remind everyone who's not listening, we do have a little challenge here where certain staff have to pay £10 and certain staff have to pay 50 pence or a pound these days if you say the C word, which is I'll say it, then I'll pay the tenner. So it's Christmas. That'll cost me another tenner.
Jamie, you must get paid too much money. You seem to enjoy saying that word far too often.
It just everyone. I'm just must be the silly man that gets caught out all the time. But I think there's definitely another £50 to £100 that's going to go in from me. Definitely. I would think at some point.
Yeah.
Well, that's good. So we've got Star Jump George and we've got Generous Jamie on the call. So I need to find little nicknames for you two now as well. Right, so yeah, so introductions done, and first from me, donate and subscribe. So I think, George, if I can just hand over to you, please, just for the kind of the week in highlights.
Yeah, absolutely. Of course. I mean, interesting week, Diane. A lot of data coming out, a lot of news flow from the political front. So, let's kick off with the equity markets. Returns on global equities have been relatively flat for the week, but we're coming off a very strong November and a very strong start to the month there. So over the week, up around 0.2%, but over the month to date, still up around 1.5% there. So still keeping that momentum going through November. On a regional basis, looking at, say, the UK, if we take the FTSE 100, so the biggest 100 companies by market cap, up around 1.6% over the last 5 trading sessions. Now, around 70 to 80% of the earnings of the FTSE 100 listed companies are actually derived from overseas. So they've really been benefiting from the sterling weakness, which we've seen against the dollar, against the euro, against the backdrop of the Brexit negotiations, but also a bit of stabilization in the dollar over the last few days there. So against the dollar, you've got sterling, which came down from around 134 at the beginning of the week to around 132, 133 there this morning as sentiment continues to roll through there. Looking more domestically, you've got the FTSE 250, which is just the next tier down in terms of market cap, so represents a number of medium-sized companies in that basket effectively. That's down 1.9% over the week, but still up 2.2% over the month to date. So still demonstrating the strength which we saw come through after Pfizer Monday, which was November the 9th, and the strong performance which we saw in equity markets, and that broadening out into the smaller, more domestic names after that key event. We also had news from the Prudential Regulatory Authority that banks in the UK can resume dividend payments as long as they meet certain criteria over into the new year. So that's something to keep a close eye on. Should be supportive for bank share prices, especially as we move through the day today. In the US, you have the S&P 500, which is relatively flat in local terms, up about 1% in sterling terms over the week, but the Russell 2000, which gives more of a view of, as I mentioned there, the smaller companies, the more domestic names, they're up nearly 4% on the week. So that's really demonstrating, again, that broadening out which we've seen in the markets, the deconcentration away from the big technology names that have really pushed on through 2020. But of course, all of this data is still sensitive at this point to COVID-19 infection rates. In Europe, relatively flat. You've got the Euro Stoxx 50 down around 0.2%, but more of a mixed session again. We had the initial vaccine euphoria. We've still had the benefit of November, the first week of the month of December, but case counts are still very much on people's minds at this point. Similar picture in Asia outside of China, where you had the Shanghai Composite down around 0.9% in trading overnight as the US continued to put pressure on Chinese tech markets. So that's a bit of a mixed picture there for the equity markets overall. Some positive news which has been coming through on the economic front. Here in the UK, we had the reports of the UK House Price Index, which demonstrates house prices for the month of November were up around 7.6% year on year, or 1.2% for the month of November relative to October. So that's really demonstrating the optimism of UK property consumers and the benefit of the packages which Rishi Sunak put together to really encourage movement in the housing market. We also had positive retail sales growth of around 0.9% year on year. And interestingly, and I'm going to steal a line from Jeff Casson and plug Morning Markets here, Jeff was talking about the proportion of sales which are online. And this is something which I know, Diane, we spoke about on one of the sessions we did on technology on the podcast. Around 59% of the transactions in that month were online. So it's demonstrating that transitional shift which you've seen in the behavior and how they actually. Markets generally a positive week for bondholders. You had yields coming in across most developed nations ahead of a number of key political and policy events. So in no particular order, in advance of the European Central Bank meeting, which we had yesterday, there was an expectation that the central bank would be further supportive. They would increase the size of their stimulus package with an expectation of the duration to be increased slightly as well. On the announcement, they did meet that expectation in terms of the amount. They injected an additional, or proposed to inject an additional 500 billion euros in terms of bond purchases, but actually extended the duration of the period which that package would be around, and also offered support to businesses by way of more low-cost loans. So really supporting the households, really supporting businesses in the pathway to recovery. We've got a number of central bank meetings next week, the Fed in the US on Wednesday. We've got the Bank of England Monetary Policy Committee and also the Bank of Japan. So we'll keep everybody updated on morning markets with what we're seeing there. But supportive moves there from the European Central Bank. I think in terms of the reaction, we had yields coming in across Europe. So looking at the bond with, say, 10 years until maturity, the yield came in around 2 to 4 basis points over the week, and similar for longer dated bonds. But around the time of the announcement, we had yields push out slightly, suggest a bit more of a risk on mood in markets. Remember, as yields are coming in, you've got the price of a bond pushing up there. So that's a positive aspect. On the fiscal side as well, so by way of government spending, we also had positive news from Europe that the European Union are closer to pushing on with their 7-year budget plan. So they've overcome the obstacles they were facing with Poland and Hungary, who are more accepting of the terms, which is significant. It prevents a scenario which would have potentially been one of the past. Now, had a revised fiscal stimulus package come to the table, around $916 billion. Which again is eye-watering sums of money. It's slightly less than what was initially proposed, but we know we've been at this impasse for many months, especially leading up to the US presidential election. So this was actually the first package to come back to the table since the US election. And it's important because we've got a number of key support packages for the employment sector due to roll off at the end of this month. We know savings in the US remain elevated, so there is that buffer there, but we need to get some sort of agreement through for that support for the labour market. Overall, yields on 10-year treasuries came down from around 0.97% to 0.91% at the point of reading last night. Again, as yields coming down, prices rising, so that's positive. In terms of the UK, Brexit negotiations, we had the bleak picture painted from Boris Johnson last night. We had Europe publishing emergency plans to keep planes flying and keep trucks moving should we reach a no deal event by the end of December. I mentioned the moves which we've seen in sterling relative to the dollar. Currency remains volatile. Around discussions this week, we had sterling against the euro, retreat from around 111 to around 109 this morning. But in that time, you've had that volatility. You had the key point on Wednesday after the Northern Irish Protocol was met. So another plug for our content. My colleague is writing an article on this today, which will be issued available for all of our viewers as well. In the UK, the bond market was reflecting some of those moves in terms of sentiment, how the deal is progressing. So you had the yield on a 10-year government bond coming in from around 0.35% to around 0.18%. So that's quite a significant move in terms of the bond market, and suggesting that there was an appetite over the week to hold government-backed bonds in that marketplace there. So suggesting that markets are looking back to the prospect of life under WTO rules or an Australia-style agreement, to label it in that way, as Boris Johnson is suggesting. But at this point, key sticking points are around fishing rights, it's around regulation. One of the major hurdles is out of the way this week, so that does hopefully clear some of the path to accelerate into negotiations as we move towards that important deadline. So I'll pause there because I'm conscious we've got a lot of questions to get through today, Diane.
That's all right, George. Thanks very much. I think, I think, like you said, there's been a lot going on, and I think the closer that we get to the 31st of December, I think it's just going to feel extremely hectic for everybody, because we're going to have tier changes, we're going to have more Brexit discussion. And I know when we very first came into the COVID and the lockdown situation, people were like, oh, bring back Brexit. And now you've gone from Brexit to lockdown to now Brockdown. It's absolutely crazy. But I think one of the first points that you touched on was the reintroduction of dividends, which actually leads nicely on to, we got a question from a couple of people about dividend payments. And one of the questions from Alan and Glenn was, is now a good time to invest? And so Alan and Glenn would like to know, what is now a good time to invest? But Philip was also asking, how do dividends work within the investment? Do TP collect them, or are they paid into the policy? So George, just carrying on with your theme, if you wouldn't mind answering those questions, please.
Yeah, sure. So is now a good time to invest? Broad market indices have come a long way since the 23rd of March, which was that low in markets. We've seen a real recovery during that time. So you've got the US, put that into context, the S&P 500's up around 65% since that point in time. So back up to all-time highs. So it's a really interesting question in terms of the timing. One of the things which we discuss in morning markets each day is the detail below the headlines. So we'll touch on the performance of different indices, so capturing companies with as I mentioned there at the beginning, smaller market capitalization relative to the larger market cap firms, or looking at different sectors, looking at technology against what's happened in utilities and banks, or any industrial style firms in the marketplace. So you're seeing at headline level a real recovery, but under the bonnet you're actually seeing quite a bit of divergence. We know this year has been a year which has really benefited certain companies more than others, mainly technology names, and anything which has had a sort of customer facing service aspect, hospitality as an example, has been more challenging. So what we've seen in terms of those divergence, it does create a great deal of opportunity in the equity markets from this point of view. I think it really touches on the aspect of having active management, so they can actually get beyond investing in a broad market index and invest on a specific basis, look at the individual companies. When we've been discussing this with our managers, we've seen examples of managers moving into a number of these positions, which are to benefit the reopening of the economy, hospitality, travel, all of these different areas. And it's a similar picture in the bond markets as well. So what we're saying there is, yes, markets have performed very well at a headline level, but there's a great amount of opportunity once you get under the bonnet in terms of the divergence you see in between sectors. So is now a good time to invest? I would say there's still a lot of opportunity out there for returns, and I think we're in a good position with our suite of active managers in order to extract that. I think the second point was just around dividends, you know, how they're paid, how we collect them. I think I'll just sort of aggregate between you know, fund and the client-specific policy, which might help me here. The fund is invested in a number of individual asset types, one of these being companies listed on the stock exchange. And when companies issue a dividend, that's paid into the fund. So that's held within the fund construct. At a client-specific policy level, it depends on the portfolio which they hold. So I'll give two examples of how a client could benefit from a dividend as an example here. If they held, say, the balanced portfolio, the income received by way of dividends from a company is effectively reinvested within the fund. And we've discussed in the past the benefit of, you know, compounding within a fund in these small regular amounts. We can do that within a fund construct through access to dividends. So within our balanced portfolio, as an example, we've got access to a income specific manager, so you do get those dividends come through and reinvested. If they hold an income portfolio, they can select to have the income which is collected from the fund by company dividends, coupons from bonds paid out to them each month, so they can have that. They've got two options there in terms of how dividends have an impact on their investments, whether it's reinvested or whether it's pooled and paid out as an income towards those.
Great, thanks very much, George. I think everything that you've said there also alludes to the fact that our technology, certainly the client-facing technology, supports what we do within the funds and within the policies themselves. So as a quick switcheroo, we have a question that I think I'll come to you for, Greg, which is Rachel was asking, as a low-risk investor, how does she find an investment that's suitable?
Yeah, I think when I seen the question, Diane, I thought it was probably one of the most common questions I get and kind of hear from even family and friends is there's this assumption that investing is always risky. And I think at True Potential, we always start off when we sort of profile and fact find clients as we do an attitude to risk questionnaire. And that's a series of questions which derives you at an outcome. And the first outcome is one of two things. You're either a zero investor, which means you're not suitable to be invested into the market. And obviously the preference there would be holding your investment in cash. And that could be because either you're not looking for significant returns, or you're certainly not willing to take enough risk to gain a return. So first output is a zero risk investor, but we seldom see that. In the main, clients come back with a positive return, and a positive return is anything from aggressive, which is where you're invested in, heavily in equities and in higher risk, but in the main higher return in investments. But then the profile rating goes right from aggressive to capital growth to balanced, then cautious, and then we've got a defensive model. And I think that's probably the main kind of principle of True Potential is no client's getting invested in anything that's outside of their comfort zone. So for any client, when they're onboarding themselves, is really sitting down and running through those kind of scenario questions of how much am I willing to invest, how long for, what would I be comfortable losing before encashing. And it's obviously there for a reason. And we'll look at some of the figures George just mentioned. Since March, it's been a rocky road, but actually a lot of our clients were comfortable with that because they know they're in a portfolio that matches and suits their risk. So when coming out as a defensive investor, you're then going into a portfolio which George and the investment team on a hourly, daily, weekly, monthly basis sort of model and map to make sure that's in line with a defensive investor's profile. And I think that's really important, Rachel, and anybody else that's kind of maybe on the fence of investing or thinking maybe I am a bit cautious, it's kind of realizing that actually at True Potential we've got portfolios suited for all investors, as opposed to, looking to shoot the lights out every single day. That's certainly not what we're here for. It's not to put money at risk, it's to put money at return, but certainly within the sort of risk tolerance or the risk bandings, and that's why we've got the 5, as opposed to just putting everybody into one aggressive style portfolio.
Thanks, Greg. I think it's interesting as well that Rachel says she's a low risk investor, and I think sometimes what we find is people aren't necessarily as adverse to risk as they think they are when you go through the risk questions and you do ask them the questions in relation to the term of their investment, how long before they want to withdraw money. It does actually start to prompt, well, actually, I don't need it in 2 years. I'm actually saving for the long term, so I probably can take a little bit more risk than I thought I would. And it's not like we're saying you're going to lose all of your money or you're going to double your money. What we're saying is how much of that payoff do you want to trade for the risk that you're willing to take? And I do think that people are quite cautious, obviously, when it comes to investing, and they don't realise, and I think Greg, you and I have spoken about this, they don't realise that money sitting in cash is actually often worth less than they very first had when it started to sit in cash, under the bed, in a bank account, wherever that cash might be, because of things like interest rates and everything else going on in the market. It's kind of, if you don't take a little bit of risk, you're really not going to get a return at all. In fact, you could be a little bit worse off.
Yeah, I think so, Diane. And I think the way I always sort of, if I am talking to family or friends about it, the one thing I'll always say is, if you've ever seen the movie Wolf of Wall Street, it's absolutely nothing like that. Because I think people do almost have a perception of the stock market is for, the sort of the rich and famous kind of thing. It's obviously not a True Potential. We take minimum investment of £1 upwards, but we treat it exactly the same as if we were to get a £600,000 pension. And obviously going through that profile questionnaire is, I'd always say, the first thing to do before thinking about investing. Is not looking at the performance, it's not looking at the historical information, it's looking at your circumstances. And as a cautious investor, which I probably shouldn't say, but I am as well. I know I'm probably young, but I actually would prefer to be a bit more cautious. And I shouldn't have said that because I've got a feeling that will come back to bite me on the backside in later podcasts. But there is a portfolio for everybody, is probably the message to leave on that one, Diane.
As cautiously investing as you are driving, Greg?
Exactly. That could be Greg Cautious Lang. That can be my nickname. Not
a problem. Unless we just have caution printed on you, in which case that might be a problem. But I think it's interesting what you said there about like the rich and the famous. Did you say, here I go again with the Daily Mail? I know it's my holy grail. I can't help it. It's a guilty pleasure. About the guy who has turned, I think it's something like 100 of his employees into millionaires. He owns the website Look Fantastic. Jamie and, well, the 3 guys I know all about Look Fantastic because it sells makeup and things and does nice stuff for your skin. So, so he's been investing for a long, long time. I think it was floated, I think, last year at some point, and he's given shares away. So they're a profit share company. So this year he has awarded them, right down to drivers, warehouse guys, accountants, administrators. They've all been paid in excess of £1 million. So he's essentially gone for festive. I'm going to use the word Noel. I'll use on Noel just in case. He has £1 million. And I think what he said yesterday was they're looking to do that. I think he's going to pay out something like 175 million in payments to these guys, which is it is just really lovely. And times like this, you do see the nice side of people, like everything that True Potential has done for us and the Cash for Kids. When people want to kind of pay it forward, and I think we're very lucky that we work for a company that also sets those kind of examples. So Jamie and Rebecca, you two have been silent for quite some time. So I think what we'll do is we'll bring it over to a question, Jamie, if you wouldn't mind. So a guy called Steve has asked, when he's taking an income, is there a good time and how does he know how much to withdraw? So on the flip side of investing, if you are looking to take money from one of your investments, How do you handle that, please?
Yeah, I think it really depends on the type of investment that you have, Steve. So, for example, if you're taking money out of an ISA, there's no tax implications with that. But if you're taking money out of your pension, you typically you'll get 25% tax free, and the rest will be taxed at your marginal rate of income. So it really depends. What I always say is try to, when I'm working with clients and on retirement planning and I'm trying to understand what their expenditure is, it's actually asking what your expenditure is in retirement is actually quite a difficult. Going through, as Daniel Harrison just having a wave behind.
Yeah. Not distracting at all.
No, not distracting at all. But what you have to do is really just go through your expenditure now and go, actually, what will I require in retirement? What, will I need a little bit more for holidays, or will I need a little bit less for travel? And it'll give you an understanding of what you need. And at that point, you can start to look at how flexible you want to take your income. And I would always say speak to an advisor about this, because it may be better to take your money out of your ISAs. It may be better to take your money out of your general investment account. It may be better to take your money out of your pension. It really depends on your circumstances and your tax position at that time. And you just want a bit of guidance from your advisor rather than some specific advice. But I would recommend doing that. What you don't have to do, which is a common misconception with pensions, is, as soon as I retire, which is at 55 or 65, I'll just take 25%, get the cash and stick it in the bank, because that's kind of old style what people would do. Now you've got that flexibility of drawdown, where actually I've just set up an income for a client where we've tailored his tax-free cash, and the income he's taken from his pension, so he's paying no tax at all, because he's using his allowances, which is quite important. And I think these are the sort of things that you have to really understand when you're going through taking your money out of it. It's just as important as taking it in. The other thing to consider is taking too much out. So if you're looking for long-term sort of income requirements for your retirement, you could, by taking too much out your pension, it could incredibly erode it, and you could run out of money. I was speaking to a client a couple of weeks ago where he did exactly that same thing, and he's 67 now and he's had to go back to work. So it's important that you understand the percentage and what actual withdrawal. We use a safe withdrawal rate of what we call 4%, which is 4% of your investment. But I think my two tips for this on this, Steve, would be speak to an advisor and then just have an understanding of what you need. So try and work out what you do need as a minimum, and speak to an advisor about how to tailor that in the best and most tax efficient way for you. And then he'll also let you know if you're taking too much. And I think that's why it's important to save early, which is what we were talking about before. Yeah. So it looks like we've actually lost Diane. So in typical style, I'll try and take over, because we've got quite a lot to get through. Rebecca, I'll come across to you first of all. So we had a question from Charlotte, which is something that actually we're seeing a little bit at the minute, which is, if I'm made redundant, what happens to my pension? And obviously there's two types of pensions you can look at, but can you just give a bit of an understanding to Rebecca, to Charlotte, about that?
Yeah, so I think the important thing is that the pension is your pension, Charlotte. You're not going to lose your pension. Your employer doesn't own that pension at all just because you no longer work for the firm. And that pension does belong to you, and you can still access that as and when you reach retirement age. Prior to that, you can make top-up payments into most pensions, so you can still set up your own direct debits. You could speak to your new employer about making payments into that same pension as well. You can also still have the same flexibility of moving your pension around between providers. So the top and bottom of it is not a lot happens to it, really. It's still your pension. The only difference is that employer that you no longer work for is no longer going to be paying into it, but it still sits there as it was before. It's still invested. You can still pay in, and you can ask your new employer to pay into it as well.
Thanks, Rebecca. And I'll add to that as well, is that there is two types of pensions that you can have. And typically for auto enrollment, you'll see people have standard what we call defined contribution pensions, where the pension's owned by you. There is where so you contribute, your employer contributes. We've also got defined benefit pensions. So if you leave the organisation, then you may have a defined benefit that becomes effectively become what we call a deferred member. if you are, you can't just move them types of pensions, and the regulator, and we would say that potentially wouldn't be in the best interest to do so. So always take professional advice if you're looking at this. And we're just having a bit of a laugh because it seems like people are taking televisions out of the office and everything. Greg, do they actually work for us?
People being bagel.
No,
Yeah.
I think Laurel and Hardy have arrived, Jamie. I'm waiting for it to be dropped onto my head or something like that. I don't know if it's the Chuckle Brothers or Laurel and Hardy. Who knows? But or you're right, burglars. But
well, we'll come across to you, Greg. Actually, so there's a good question from Frankie. And I looked at something the other week, which is actually people using the True Potential apps tend to log in 4 times more than people using the website, which is quite interesting. There's a good question from Frankie, which is there's a lot of information on the app. What should I be paying attention to?
Yeah, Jamie, it was another question when I seen. I thought that's a good question, because I sometimes think the same when I log in, because obviously we've got the 2 main ways of logging in. We've got the web browser on the client site .tpinside.com, and then obviously we've got the mobile app. And I think that for me, the way I differentiate the two is, if I'm just looking to log in to see what my pension's worth or ISA's worth, or indeed top up one of the products that I've got, I'm more inclined to use the phone, because facial recognition, you're straight in, you press a couple of buttons and you're away. So I think for me, what I do is I break it down as to what I'm looking to do, what activity I'm looking to do on my client site. If it's something a bit more complex, like maybe transfer a cash ISA from the bank, or read some policy documentation, or an annual statement, I'll probably do that on the web browser. So I think the first way I'd answer the question is probably not directly answering it, which is I work out what I'm looking to do first. And the stat you're saying there about clients logging in four times more if they're on a mobile device is probably to be expected, because your phone tends to be in your hand more times than your laptop. You're out and about. And obviously we're not out and about as much at the moment, but you do tend to be on your phone to do your mobile banking and stuff, and you think, well, I'll just log in and see what my policy's valued at. So when I log into the app, I'm normally looking at 2 things. What's today's value, which is obviously the number one reason all clients log in. And then the second thing I do is, because I've integrated my bank accounts and credit cards and things like that, I also just have a quick scan of my account. So it tends just to be to look at, what my worth is that day. That tends to be the number one reason to log in onto the app. But because the apps and the websites have been designed to cater for, hundreds of thousands of clients, if not millions of clients, who can log into the True Potential apps, there's obviously a lot more you can do with it. So they are there for, somebody that wants to run a CGT calculation. We've got all of the historical, dividend payments and income payments, as George was talking about earlier. But simplified for me, why I would log in and why I think most people log in is looking at today's values. If you ever need more information or to navigate the site, we've got probably the best customer care team in the world, Rebecca, which you run, who can help clients navigate their website and talk them through what every single bit of information means. So what I'd say is, and this is to everybody on today's session, log in, have a look around, and if you're not sure, get in touch. That's what we've got, a very large team of helpful staff, all working from home at hand, just to navigate and guide you through and really get the most of your website. You can do a lot of things on there. I mentioned earlier, topping up, make it easy by putting some money in at the end of every month, not taking money out, because you should be staying invested for the long term, as George will allude. But I think most importantly, just getting the most out of the website. It's exactly what they're there for. So don't be too put off. There's a lot of information in there, and keep in touch with us. Ask us questions, and Rebecca and the team are pretty much round the clock on hand to help you use the website, James. That would be my sort of key point. Use the right device. So if it's a quick and simple thing, use the phone. If it's something a bit more complex, maybe use the browser where you've got a bigger screen, but never be put off and always get in touch with us. We've got live chat where we do video sharing. We've got text chat, phone lines, emails, secure messages, and so on and so on. So do get in touch if you're ever unsure.
Thanks, Billy. I think it was interesting during the sort of little dip that we had in March in the markets. A question I was asked by an advisor was, do you regret having so much information on the site so clients are aware that their investments are dropping rather than a typical provider that gives them every 12 months? And my answer to that is no, because I think transparency is so key to us, and being involved with the investments and your goals, because you may have to put more money in, you may not achieve your goal by that. And I think being transparent is really important. And just moving topic slightly, as we all seen this week in the news, the first vaccine was given, and I seen the second vaccine was given to a gentleman called William Shakespeare. I don't know if anyone seen that on the telly, which was pretty phenomenal. I reckon there was a distance relationship, but there's a good question from Simon, and George, I'll point this towards you if I may, please, which is, I think it's good from my point of view, which is how will your investment approach change now we have a vaccine? Will you be looking back at airlines, for example? I think that is a good question.
It is.
George, can I pass that to you? Yeah,
absolutely. I think as a starting point, there's a greater appetite to have exposure to more economically sensitive parts of the market. That's not immune to true potential. That reflects a lot of the positive moves which we've seen through November and through the month to date, and we've emphasised that position at the margin for our investors. So they've been beneficiaries of those moves within the portfolios through the changes we've made at manager level, but also in terms of the moves the managers have been making under the bonnet. But I think it's worthwhile, distinguishing between process and approach. From True Potential's perspective, as a starting point, our investment process remains the same in all market environments, in the sense that we still go through all the same stages of analysis, looking at the positioning of our underlying managers on a day-to-day basis, reviewing the performance of our appointed fund managers, looking at any changes which they're making so we can really draw out and challenge their views at any point in time. So that process in itself allows us to see how the approach is developing with our appointed fund managers. The key point here is our fund managers have vast research capabilities, which through our relationship we have with our managers, we've got direct access to, and the advisors we work with will see this through the webinars which we run on a regular basis. I think our managers have known that a vaccine will be a critical event in the can step forward in terms of ending the restrictive activity which we have around the pandemic. Trying to pin the date is not always possible. I'm not sure, 5 months ago you could have pinned it was on the 9th of November, but through their research they knew that we were getting closer. I think in terms of their approach, some of our managers were already there. So some of our managers were already in a position which would benefit from the scenario which we saw play out, which was the vaccine news coming through and the real broadening out of markets, lifting some of those really underperforming areas of the market. Other managers who were more neutrally positioned were very quickly to act on that. So you've got both sides there, but what's important about that is you've still got the balance, because we know that we're not out of the woods yet. You've still got a sensitive marketplace to things such as, we had on earlier in the week further news around the success of the vaccine. We had the response that there's 2 allergic reactions coming through. So markets do remain very focused on that, and the fact that many areas of, say, the UK sat here in tier 3, we are still under restrictive rules. But I think what it's demonstrating is that there is that appetite to have that greater exposure to the more cyclical areas of the market. In our approach, our managers at some degree have emphasised that. Some of our managers were already the beneficiaries of that, and hence the performance which you saw in the True Potential portfolios over the month of November. So, our research process remains the same, but our approach has been to really lean into this area of the market but keep that level of diversification. As I say, we're not out of the woods yet, so we don't want to put all capital at risk by being too concentrated in one specific area. We maintain the balance, we maintain diversification for our investors.
Brilliant, thanks, George. It definitely is an interesting one, because you would hope once we start to get to a bit of normality after this vaccine sort of distributed, although we don't know really the speed of the distribution of the vaccine yet, but they are hoping by, I think it's the end of February, to get all the vulnerable sort of vaccinated.
Yeah.
So you do. Yeah, you go.
I was more surprised by keeping my concentration there while trying to work out what's going on behind Greg.
Yeah, there's definitely some activities going on there.
I think we are actually now getting burgled. I've sat in this office pretty much on my own for 9 months, and today on the podcast, it seems like everyone wants to be in the background. So,
yeah, Greg, just let everyone know that actually that telly is actually going in the back of your car now, isn't it? Really?
Yes, that's right, Jamie. It's going to my new games room.
I thought so. Rebecca, we'll come across to you now. A question from Lynn and Annie, which is, how do I access my workplace pension when I retire next year?
So the first thing is just give us a call. Let us know that you're wanting to start withdrawing from your pension, and then we'll talk you through your available options. As you've already touched upon, Jamie, it may be appropriate for clients to speak with a financial advisor at that stage if they're not too sure how much they should be taken out, or if it's the right time to start withdrawing from their pension. So let us know and we can arrange that. If you do know exactly how much you want to take and when you want to start taking it, then we can actually activate a feature on your client site, which will allow you to go through and give that instruction yourself straight through your website.
Brilliant. Thanks, Rebecca. And there's a question for me, so I'm going to ask myself this question rather than Diane asking me it, because she seems like I am worried about Diane, so maybe someone should give her a call to see she's okay. But just a question from Ron. Ron's asked himself, and just getting the right details up there. He's asked about whether he should take his lump sum out at 55. And I did mention this before, and I think there's a common misconception that you should just take your 25% out when you retire at 55 or 65, whenever that is. And that might be the case if you've got ambitions in terms of spending money. But what I would say is that look at what you want to spend your money on. So if you want to do some home improvements, then that's perfectly feasible. But if you're just wanting an income, moving 25% of your pension into the bank is not the sort of the best, most tactical way I would advise you to do it. Actually, I definitely wouldn't advise you to do that. So it's worth just understanding how you want to flexibly withdraw your income, or actually you may wish to do something else, but don't just pull out 25% of your funds and stick it in the bank. I wouldn't advise that at all. You're really sort of moving your money from a really sort of tax efficient environment to somewhere where it could be eroded by cash. Right, let's have a quick look. I think we're all done for questions here. Yeah, we are. Great. So I think we'll have a little bit of a wrap up here. Greg, I'll start off with you, with the exception of setting up your new television in the games room in the house. What's the plans for you this weekend?
This weekend, Jamie, absolutely nothing. As strange as it is, I probably will not be leaving the house. Obviously, we're in Tier 3 in Newcastle, so you can't go to a restaurant or anything like that. I couldn't think of anything worse than going into the town centre and doing any type of shopping, especially festive shopping. So I'll probably get the dog out for a walk, Jamie, maybe go for a run, and nothing much more than that. There's another TV on the way. I'm sure somebody's like trying to pull a prank on me here, so it's gone backwards and forwards now. So, but no, Jamie, not a lot, unfortunately, or fortunately, depending which way you look at it. But as I was just talking to Daniel Harrison, CEO next door, there's a new computer game come out, and I may or may not play on that. And I'm not going to take that one any further because that'll come back to bite us as well.
Yes, that's probably wise. And Rebecca, what's the plans? You got the Prosecco ready for tonight, or?
I'm actually very excited, Jamie, because the salons have reopened. My salon only opened again this week, despite most places opening the week before. So I'm getting a massive and then probably a glass of Prosecco afterwards. So I'm very much looking forward for it.
It is crazy times, isn't it? When we, you get excited by, I got my hair cut on Saturday, and I think my wife Annie was more excited about me getting my hair cut than I was. But just the little things that are, sort of make the difference now in terms of, we don't have any restaurants or pubs open at the minute where we are. It's so I'm hoping by next week it's being reviewed that we may see them reopen, which would be nice just in time for the big man to come. And George, I already know what you're doing. You're probably going for a bike ride at Kielder or something like this, because it seems to be what you do most weekends. Or is it?
Not this week. I picked up a bit of an injury earlier in the week running in the pitch black along a bridle path. So I'll leave it at that. So I'm having a bit of a quiet weekend, actually, Jamie. I think I'm going to probably try and do some festive shopping online to fall into one of those statistics that I was talking about earlier. But that's not just because we're in tier 3. I think I try to avoid the shops in the city centre around this time of year at all costs. So it's either gifts from a petrol station or what I can pick up from Amazon. Wait
there, George. I think we need to elaborate on that run. So did you fall over?
Yeah, I know the bridle path really well. I go along it most mornings, and I had a head torch on. It was pitch black, and I thought, I know where I'm going. I'm fine here. It doesn't matter that I can't see this little section. But it was soaking wet, and it was covered in mud, and I had a bit of a fall, which was sort of lying there thinking, I hope nobody's seen this in the pitch black on a Tuesday night. But I'll still finish the run though, Jamie, and I'll be back. So don't worry.
I wish I could admit that I hadn't done that before, but yeah, I'm the only person that can. Well, I thought I was the only person that could trip on a run with no one around me, but obviously you must be as clumsy as I am, George.
I slipped. I didn't trip though, so.
I tripped over a curb once at 5 a.m. Someone was watching out the window, so pointing and laughing at me. But I literally I think it's. I'd end up causing damage in an empty room, to be honest. I'm that clumsy, but never mind. Nothing much from me this weekend. I think I'll be the same as you, doing a little bit of festive shopping on Amazon. Just put our recycling out for the bin driver today, and we've got another sort of 5-6 boxes on the side of the bin. It's just amazing how times have changed. I don't think I haven't even been in the Metro Centre since it opened, which is the big shopping centres. I've kind of just got used to using Amazon, which I sort of did before, but now I'm so reliant on it. It's just, you just buy everything on there, don't you? Mm-hmm. You can understand why it's done so well, George, from a market perspective, being one of the biggest companies in the world now. Brilliant. Well, I'm hoping Diane's okay and she hasn't tripped up on her run. But thank you very much, everyone. Thanks to Diane for starting, and leaving halfway through. We'll make sure she doesn't forget that. But thanks for the panel. Thanks everyone for the questions this week. Some really good questions, and we love speaking to clients. We really do. We love helping clients, and seeing lots of questions which we get through for these types of podcasts is fantastic. So please keep them coming through. If you do have any specific questions for yourself, you can speak to the customer care team, or you can speak to your advisor. As I said, we're always happy to have any sort of conversation with clients. It's really a pleasure to do so. And I think just a little reminder just to subscribe. And also we've got the charity that Diane was mentioning, which is costing me a small fortune, but actually a very good cause. So not too bothered about that. But thank you very much, everyone. We will see you again. Thanks so much. Thank you.
Thank you.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.